Good morning. My name is Nitesh Kumar from BMS 3C, and I am going to give a presentation on the topic mutual funds. In this presentation, we shall first be looking at the definition of mutual funds, followed by its various characteristics. We shall then be exploring how to establish a mutual fund, followed by the definition of net asset value, which is an important concept under it. We shall then be looking at the types of mutual funds and the benefits of investing in them. Without further ado, let us begin. Let us first look at what are mutual funds. A mutual fund is a pool of money collected from the investors and invested according to certain investment objectives. Mutual funds are operated by professional money managers who allocate the funds asset and attempt to produce capital gains or income from the funds investors for the funds investors. A mutual funds portfolio is structured and maintained to match the investment objective stated in its prospectus. Mutual fund is created when investors put their money together. It is therefore a pool of the investors' fund. The most important characteristic of the mutual fund is that the contributors and the beneficiaries of the fund are the same class of people, namely the investors. The term mutual means the investors contribute to pool and also benefit from the pool. There are no other claimants of the fund. The pool of funds held mutually by investors is the mutual fund. Let us now look at the characteristics of mutual funds. There are five main characteristics. The first one is regarding the ownership of the mutual fund. A mutual fund actually belongs to investors who have pooled their funds. The ownership of the mutual fund is the hands of the investors. The second characteristic regarding mutual funds is about its management. A mutual fund is managed by investment professionals and other providers who earn a fee for the service from the fund. The third point is regarding the investment. The pool of fund is invested in a portfolio of marketable investments. The value of portfolio is updated every day. The next feature is about the shares. The investor shares in the fund is denominated by units. The value of the units change with the change of portfolio's value every day. The value of one unit of investment is called the net asset value or the NAV. The investment portfolio of a mutual fund is created according to the stated investment objectives of the fund. This is the fifth characteristic. Let us now look at how to create or how to establish a mutual fund. There are essentially four separate entities, namely the sponsor, mutual fund trust, AMC or the asset management company, and the custodian, which are required to establish a mutual fund. The sponsor of a trust and the instrument of the trust should be in the form of a deed registered under the provisions of the Indian Registration Act 1908. The sponsor is required to contribute at least 40% of the minimum net worth. The board of trustees manage the mutual fund and the sponsors execute the trust deed in the favor of the trustees. It is the job of the MF trustees to see that the scheme floated and managed by the asset management company appointed by the trustees are in accordance with the trust deed and SEBI guidelines. Essentially, a mutual fund can also run as a company or as a trust. However, under the SEBI guidelines, it is necessary in India to have the mutual fund as a trust. The custodian is simply the body which is responsible for storing all the investment that is collected and looking after it. Let us now look at NAV, which is the net asset value. The net asset value or NAV is the value per unit of a scheme on a particular day called the valuation day. NAV represents the fund's per share market value. It is the price at which investors buy, which is the bid price, fund share from a fund company and sell them, which is the redemption price to a fund company. A fund's NAV is calculated by dividing the total value of all the cash and securities in a fund's portfolio less any liabilities by the number of shares outstanding. This formula is also provided in the slide. Let us now look at the type of mutual funds. Mutual funds can be divided into types on multiple bases. The first basis that we'll discuss is the acceptance of funds. On this basis, a mutual fund can be divided into two types: open ended and close ended funds. An open ended mutual fund is one which sells and repurchases on a continuous basis. A good example of it can be Unit Trust of India's Unit Scheme 64. On the other hand, close ended funds are offered for subscription only for a limited period of time. A good example for this can be Master Shares, Master Gain 1992, Cashmere, SBI Magnum, and etc. Close-ended funds are generally short-term and mature in 3 to 4 years from their launch date. Another basis on which mutual funds can be divided is the benefit which is derived from it. On this basis, there are two types of mutual funds. The first one is the income fund. An income fund is a type of mutual fund or exchange traded fund that emphasizes on current income either on a monthly or quarterly basis. On the contrary, the other type, growth funds, aim to provide higher growth and capital appreciation to the investors. A growth fund is diversified portfolio of stocks that has capital appreciation as its primary goal with little or no dividend payouts. There is another type of fund between them, which is the income cum growth fund. These funds aim to provide the investors with a small but steady income along with reasonable growth. Another basis for the types of mutual funds is the geographical area. On this basis, there are two types of mutual funds. One is the domestic fund and the other is the offshore fund. Domestic funds are funds which are open for subscription in the country of origin itself. Offshore funds, on the other hand, are those funds which are subscribed abroad for investment in the country of origin. These offshore funds have dual purpose of bringing fresh funds in the capital market and also bringing precious foreign exchange for the country. At present, there are many offshore schemes floated in India. Uh, these are also used as a often used as a tax haven. Another basis for the types of mutual fund is the type of security in which the mutual funds invests in. On this basis, there are two types of mutual funds. The first one is the equity fund. These funds invest in predominant portion of the funds. Uh, in this type of fund, the predominant portion of the fund is mobilized in equity and equity related products. In most cases, about 80 to 90% that is of their investment are in equity shares. These funds have the freedom to invest both in primary and secondary market for equity. One variation for the simple equity fund is the ELSS, which is the equity linked saving schemes. These funds, named variously in mutual fund histories, are equity funds formed under special scheme notified by the Government of India. According to the provisions of this notification, investment in specifically found mutual fund product that invests at least 90% of its fund in equity and equity linked investments is eligible for a tax rebate up to maximum of 10,000 rupees. Investors have to hold the units for the minimum lock-in period of 3 years in order to avail of this tax rebate. Another type of mutual funds is the debt fund. Debt funds are those that predominantly invest in debt securities. Since most debt securities pay periodic interest to investors, these funds are also known as income funds. However, it must be remembered that funds investing in debt products can also offer a growth option to their investors. What is important is that the portfolio is predominantly made up of debt securities. The universe of debt securities comprises of long-term instruments such as bond issues by central and state governments, public sector organizations, public financial institutions, and private sector companies, and short-term instruments such as call money, lending, commercial papers, certificates of deposits, and treasury bills. Debt funds tend to create a variety of options for investors by choosing one of these segments in debt markets in their investment portfolio. Another type of mutual fund under the types of security can also be a balanced fund. Balanced funds that invest are funds that invest in both the debt and the equity market. A typical balanced fund would be almost equally invested in both the markets. The variation are funds that invest predominantly in equity or keep a smaller portion in debt securities. These funds seek to enhance the income potential of the equity component, by which by bringing in debt. Similarly, there are predominant debt funds also. A balanced fund also tends to provide investors exposure to both equity and debt in one product. Therefore, the benefits of diversification get further enhanced as equity and debt market have different risk and return profiles. Let us now look at the benefits of investing in mutual funds. There are five key benefits of investing in mutual funds. The very first one is the diversification benefits. Diversified investments improve the risk return profile of the portfolio. Small investors may not have the amount of capital that would allow optimal diversification. Uh, since the corpus of the mutual fund is substantially big as compared to individual investments, optimal diversification becomes possible. As the individual investor's capital gets pooled into a mutual fund, all of them are able to derive the benefits of diversification. Another benefit of mutual funds is the low transaction costs. The transaction of a mutual fund are generally very large. These volumes attract lower brokerage commissions and other costs as compared to the smaller volumes of transactions entered into by individual investors. The brokers quote a lower rate of commission due to two reasons. The first is the competition for the institutional investors' businesses. The second reason is that overhead costs for executing a trade does not differ much for a large or a small order. Hence, for a large order, these costs spread over a larger volume, enabling the broker to quote a lower commission rate. Another benefit derived from mutual funds can be availability of various schemes. Mutual funds are generally offer a number of schemes to suit the requirement of the investors. Thus, the investors can choose between regular income schemes and growth schemes, between schemes that invest in money market and those that invest in the stock market, and etc. Some schemes provide some added advantage. For example, automatic reinvestment scheme reinvest the distributed income automatically, thus making the management of funds easier. In case of direct investment in securities, the reinvestment of income uh, in the same proportion as the asset held is very difficult and sometimes impossible. Funds that invest in overseas market offer additional advantage of international diversification, which may otherwise not be feasible to the lay investor. Another advantage is the professional management provided by the mutual funds. Management of a portfolio involves continuous monitoring of various securities and the innumerable economic and non-economic variables that may affect the portfolio's performance. This requires a lot of time and effort on the part of the investors, along with in-depth research, in-depth knowledge of the functioning of the financial markets. Mutual funds are generally managed by knowledgeable, experienced professionals whose time is solely devoted to tracking and updating the portfolio. Thus, the investment in a mutual fund not only saves time and efforts for the investor, it also is likely to produce better results. The last benefit derived from mutual funds is the liquidity. Liquidating a portfolio is not always easy. There may not be a liquid market for all the securities held. In case only a part of the portfolio is required to be liquidated, it may not be possible to sell all the securities forming a part of the portfolio in the same proportion as they are represented in the portfolio. These problems can be solved by investing in a mutual fund. A mutual fund generally stands ready to buy and sell units on a regular basis. Thus, it is easier to liquidate holdings in a mutual fund as compared to a direct investment in securities. With this, we come to an end of our presentation. Hope it helped. Thank you.